And our next guest says the stock is set to fly more after earnings this week. Joining us is Kevin Rippey. He's co-head of internet research with Evercore ISI. Kevin, welcome. I mean, 25% gain this month. First of all, what's behind that?
Well, I think there's been across the internet advertising landscape an appreciation of the fact that digital ad revenue is far less cyclical than many investors have feared. So what we're seeing now is basically the stocks repricing to that reality. And when we think through what we've seen with Facebook, Google, and increasingly Snap, is they've benefited from strong e-commerce ad demand. Twitter hasn't done that, and that's why it has lagged its peers somewhat. But we think heading into this week's earnings, they'll be able to tell a story around the fact that as we're heading into July, demand from their advertising base, which is largely the big brand advertisers, is demonstrating some improvement. And by way of that, we think it'll be the outperformer of the group this earnings season.
So we should note, report second quarter results before the opening bell on Thursday. And you're also looking for pretty nice increase in user growth. Talk about that. How important is that versus some of its more financial metrics?
Right. So if we think about long-term oriented investors, what they're really focused on is the strategic value of Twitter as a platform and the fact that it would be very hard to replicate the service that it provides. And part and parcel to that, it is increasing user growth. We're thinking that users will grow near 30%, which will be, I think, a record going all the way back to, sort of the early days of Twitter as a public company. There's clearly demand for the content that Twitter has. The conversation that's happening there is, only building. And by way of that, we think long-only investors will take that to heart, appreciate it, and be the marginal buyers of shares here at the end of the week.
So let's talk, and just to be clear, you're raising your target price to $38 from $32. What does that mean for the rest of the internet space? Well,
we think, if we're talking, Snapchat, which goes tonight after the close, Facebook and Google, which are a week later, the key point here is, these businesses have been largely unaffected insofar as, accelerating e-commerce growth has, provided really a foundation or a floor for these names. And, I don't know if there's necessarily a lot to read through for Twitter. It's always sort of in a camp all of its own. But again, the trends look positive with respect to users. We think they'll have a good second derivative story to tell as we head into July and the third quarter. And that's really the basis for the call here.
So let me ask a little bit about what it means, a tactical outperform. Does that mean that this is a short-term buy and hold, and you expect to trade it? And I ask that in the context of you're raising your price target to 38 and the stock right now is at 37. That would suggest very little upside. But explain how that works. Tactical outperform and a $37 stock with a $38 price target.
Yeah, the tactical outperform is really one about duration, right? We're making this as a call around earnings with a specific catalyst in mind, with a specific time frame in mind. I think the concerns we have about Twitter long term really relate to infrastructure, technological architecture, those sorts of things, which are decisions that have been made 5-10 years ago, but they're really yet to deal with, and they're trying. But we think longer term, investors probably don't quite appreciate the magnitude of the cost perhaps associated with addressing those issues. They've talked about tech debt before. We think the sort of magnitude of that tech debt is one that, again, over sort of a 2-year period might, prevent shares from outperforming. But again, here in the next week or two, I think there's a very strong bull case to be made.
Kevin, one final question. Facebook and Google are only up 18% or so this year compared with 70% for Amazon. Real quickly, you think they have that much more upside? Quickly.
Perhaps not quite that much. When we're talking about Amazon, we're really talking about a multi-year pull forward of e-commerce penetration, of cloud demand, these sorts of, very important, very profound, really structural tailwinds. The advertising names don't get quite as much as that, although they definitely do participate. Our thesis really is you really don't sell product online without buying Facebook and Google ads. So there's second derivative, sort of read-throughs there, but it's not quite as impactful as what Amazon is experiencing, and for that reason, probably don't see them run quite the same way that Amazon has done post-COVID.
All right, Kevin, thank you.